What on earth is going on with Degen? The overall market rather tends to trend down today, but Degen is pumping. The question is, who's buying here? Who's selling here? How much longer could this rally last? Let's have a look at the on-chain data, the data most people are not considering. Let's try to look behind the curtain. Now here's the current situation. We are at 0.7 cents and this rally looks pretty much like a hockey stick. We went up by 200% this month. Now Degen is a token on the base chain. It's the 13th largest trending token with a liquidity pool of 3.7 million. In the last 24 hours, we saw 2,000 wallets interacting with the token. And interestingly enough, there were more sellers than buyers, despite the price going up. So it seems like the buyers tend to move more capital than the sellers per transaction today. Or another way to interpret this, the whales or the professionals tend to be buying in. Now the token has more than 1 million holders on the base chain, but not all of those holders are created equal, right? Some of them might just have a few cents worth of the token due to the airdrop. Others might hold hundreds of thousands of dollars worth of the token. So let's dig a bit deeper. Here's the token distribution, and the first 3 wallets are smart contract wallets that hold almost half of the supply. The 4th largest holder is Bybit, so a centralized exchange. Degen is not just a random meme coin. It actually launched its own chain, the Degen chain. So it's possible to move assets from the base chain via bridge to the Degen chain. And here we see the assets that can be traded on Degen. And all of those assets are in liquidity pools versus wrapped Degen. So not versus Ethereum, not versus USDC or USDT, but versus wrapped Degen. So when Degen is going up in US dollars, every single asset automatically on the chain goes up as well. Simply because the way those prices are determined is by the ratio in the liquidity pool versus wrapped Degen. There's a direct coupling between the prices. Now, the largest of the tokens, Degen Swap, unfortunately also crashed in price over time. Top to bottom is a decline of 99.7%. Even if you take the recent rally, it's still 99.2%. And so what's then the cause of this rally? Do we see more activity on the Degen chain? Do we suddenly see money flowing into the system again that might re-drive the price? I don't think that that's what's going on. Here we've got the total value locked, or the capital that's currently locked in the Degen chain. And this peaked at 12 million just a few days after launch and since then went down. Now it's a former shell of itself with $600,000 worth of total value locked. But is it then maybe the people on the base chain that accumulate the Degen token? Let's have a look. So what we see over here is the number of retail investors on the left, the number of whale investors on the right, and something in between in the middle. So let me get out of the way. The way how we determine a retail wallet is by looking at a minimum holding threshold. So the wallet has to hold at least 100,000 Degen tokens. At the current price, that's roughly $700 worth of the token in order to be counted with this chart here. So we are not counting more than 1 million holders. We are just looking at the wallets that have some kind of relevant money in this. And then the number goes down from 1 million to only a bit over 5,000. So that's only 0.5% of the Degen holders. Now for the chart in the middle, we go at 10x in minimum holding. So that's 1 million tokens or $7,000 worth of the token. On the right, another 10x, so 10 million tokens or $70,000 worth of the token. Now we don't really see how any of those wallet cohorts is going up in numbers. As in, it doesn't look like the number of retail investors is suddenly sky high. It doesn't really make sense why suddenly the price is rallying that much just based on the on-chain metrics. What appears to be happening is that a few whale wallets buy a lot of the supply. Not many whales, but just a few whales potentially, right? Again, the number of sellers today is higher than the number of buyers. Probably under the hood, what's going on is a short squeeze. Enough people have been betting on falling prices of Degen because the usage of the chain pretty much died. Have a look at this. This is the trading volume on the spot market. And most trading happens on Coinbase. But that's still, quote unquote, just 77 million in the last 24 hours. Now compare this with the bets on the price, the perpetual futures market. Here we saw more than $500 million of trading volume on Binance alone. So it's really the levered bets on the price that are currently moving everything. And whatever happens on the spot market is just arbitrage versus the perpetual futures market. Just have a look at this again. The trading volume on the entire Degen chain in the last 24 hours was only $2,100. This chain is absolutely dead. There's nothing happening here anymore. But here's what's going on. The funding rate, the open interest funding rate on Degen is extremely negative. That means that the shorts have to pay the longs in order to bet on falling prices. The vast majority of perpetual futures traders thinks that Degen will come down from here. And that then makes it attractive for people to buy up the token. First of all, there is some money to be made with this interest. But secondly, as there are more and more people betting on falling prices, if the price rises high enough, those people get forced liquidated. They have to buy back the token. This is how a short squeeze happens. Just have a look at how much more bets there are now on the Degen price. The amount of open interest, which is here in green, is at the same level compared to when the Degen price was still at 2.3 cents. So Degen now is much, much lower. That's this yellow line over here, but the open interest is at the same level. There's simply so many bets now on the price. This is player versus player speculation. And here's the proof that this is all a short squeeze. The shorts got massively liquidated. Now what happens with situations like this? Usually we see an initial short squeeze because people were betting on the long-term underperforming price, and then more short-term traders are attracted by the higher price and again bet on falling prices. And then we usually see a secondary short squeeze. After the secondary short squeeze, the price tends to deflate long-term. So have a look, for example, here, November of 2024. We also saw a very quick rally, then a slight retracement, and then our secondary short squeeze. We then had long-term underperformance. This, by the way, is the Degen price relative to Ethereum, not just in US dollars. And so just because we see a squeeze doesn't mean we go back down to regular levels. So my plan here is the following. I'm continuing to watch this price, and I'm not betting on falling prices yet. I'm also not betting on rising prices because who knows what's going to happen. But if we see a secondary squeeze, and if the magnitude is very comparable to what we've already seen, maybe a doubling versus Ethereum, something among those lines, then I will bet on falling prices. So I want to see a secondary rally, and when that then deflates on whatever level that will be, that's probably when we're going to get into the long-term bearish trend again. Now here's something very important to understand. Crypto is highly correlated, as in when the market tends to go down, everything goes down at the same time. There's very little variation. This is true for the bear case, but it's also true for the bull case, as in most things go up at the same time. There seems to be not so much benefit in diversification, as in it seems to not really matter what kind of token we buy. If we have 5 tokens or we've got 20 tokens, the portfolio tends to move in the same direction anyway. Now the reason for those synchronized ups and downs in the market cannot just be money flows, because the money is flowing in and out of the overall space relatively consistently with little volatility. What we've got over here is the stablecoin market cap. And since October of 2023, we tend to go up over time. So there is money getting into the system. People deposit their fiat currency, say on a centralized exchange. The centralized exchange then sends it over to a stablecoin custodian. The custodian holds the funds in a bank account and then mints the stablecoins on the chain. And we can see that minting, but also the redemption on this chart. So the volatility that all prices go up or all prices go down, it's not caused by money flowing in and out of the system as a whole. Instead, I believe it's caused by the swapping activity. So people going risk on or going risk off. So it's not the market as a whole expanding or contracting, it's the participants within the market that swap. And we can see that swapping activity with much more volatility here. So this is now the stablecoin dominance. We're not looking at the stablecoin market cap, we're looking at the stablecoin dominance. How much of all of crypto is in stables? And in the last 1.5 years, this tended to move in a range between 9% and 5%. And now compare that stablecoin dominance with the Bitcoin price. When the stablecoin dominance is low, it means the Bitcoin price tends to be high. When the stablecoin dominance is high, it means the Bitcoin price tends to be low. So there is somewhat of an inverse correlation. When people deploy their stablecoins, or when they're swapping from risk off to risk on, when stablecoin dominance goes down, prices tend to go up. And so because of that overall effect of market synchronization, because of the high correlation, things move in the same direction at the same time, it's not a good idea to just look at US dollar prices in order to make a good decision whether or not to buy or sell an altcoin. Because charts like this are also influenced by the overall market swapping activity, not just by the swapping activity within the altcoin. So for example, this here, right? This is Dogecoin. And who would have thought that Dogecoin already peaks at 46 cents when in the past it peaked at 56, 57 cents? Who would have already anticipated the peak earlier? How could we figure that out? Here is how we can figure that out. This is Dogecoin's dominance. And here those two tops align very nicely. And so a dominance chart is simply a chart that looks at the current market cap of an altcoin relative to all of crypto. So that way we remove the ups and downs of Bitcoin or of Ethereum. We are just looking at the relative performance of the altcoin versus the rest of the market. And again, that tends to trade in ranges. And that's how we can find out how the second peak should actually happen earlier in US dollars, because the dominance was already at historical heights. But check out this, right? This is Shiba Inu in US dollars. But here's Shiba Inu's dominance. So we do have a quiet, constant trend. Over time, Shiba Inu tends to underperform the rest of the market, and when we are high on the trading range, it might make sense to bet on falling prices. When we are low, we could potentially buy, but of course it's always somewhat risky to buy low when the overall trend is also bearish. So I personally prefer, when there's a declining trend, to look for short opportunities, so to bet on falling prices when we are high, and when we are in an upwards trend, to buy the dips. So when we're in a bull market, we buy the dips. When we're in a bear market, we short the top. And so Shiba Inu underperforms the market over the long term. So instead of trying to fish for bottoms here, isn't it better to just wait for the next short squeeze, to wait for the next rally in the price, to then bet on falling prices? Then the time is also on our side. Even if we see a bit of a spike above the regular trading range, we can just wait it out, because the overall trend is in our favor. That's not necessarily true when we buy, right? When we buy low in a declining trend, we might not find the exit on time and then have to sell again, potentially lower. Another example, here's Chainlink. And what we see over here, that's Chainlink's dominance. So just according to this chart, it might make sense to potentially buy some Link over just Bitcoin or Ethereum. Historically, it's rather cheap. Now, there are two central reasons why I like those relative valuation charts and those dominance charts. The first one is that we can actually see what happens specifically with that token, completely independent of the overall market. But the second reason is by plotting relative valuation charts, so say cryptocurrency A versus cryptocurrency B, we tend to see less volatility. We tend to see the trends clearer. For example, over here, this is the Ethereum price in US dollars since February of 2021. There's no clear trend. It's not necessarily easy to figure out when to buy or when to sell. But then we've got here Ethereum relative to Balancer. I like to look at this chart because it gives us two nice points. First of all, the overall volatility is rather small, but secondly, the gains are also extremely consistent. So this is an outperformance of 5,400%. This is how much Ethereum outperformed Balancer. And again, relatively speaking, with not that much volatility. Getting that much performance in a such consistent manner without having to time the market actively, that's quite unique, right? This is a risk to reward that we can only get with relative valuation plays. We can't get this just by buying something in US dollars. And again, the reason why everything in US dollars fluctuates so much is because the market as a whole goes risk on and risk off all the time. And that creates massive additional volatility. But we can get rid of that volatility. We can actually make money by buying this. Now, we don't just buy this, we have to set up a long Ethereum and a short Balancer position. So to get this performance, we have to do a bit of quote unquote financial trickery. But yeah, why do we see such consistent outperformance? The reason is that Balancer over time tends to have an expanding token supply. And a lot of that additional supply goes to liquidity mining. So to a lot of people that just get continued allocation to the token that then sell it off over time. And so this then differentiates the winners from the losers long term. The people that are willing to take one step further, they're going to look not just at the next 100x meme coin, it's likely going to go to zero, but that actually figure out what are the dynamics within the market and how can we profit from those dynamics. Those people tend to do better than just the people that buy and hold Bitcoin, for example. I have made dedicated tutorial videos on the topic. First of all, how do we even plot those relative valuation charts? How can we look at them? There's an entire tutorial section just on how to use TradingView in a proper manner and seeing the things that most people don't, right? Most people just look at things like this. This is not giving us any edge. But then there are also videos on how to actually execute those trades. How can we gain from relative valuations? How can we set this up? How can we continually make money with comparatively little risk? Now, most people here on YouTube are not willing to share their own performance, but I'm okay with doing that. I'm okay to share how much money I'm making on average over buying and holding Bitcoin. Because this is again where the big differentiator is. Everybody can get Bitcoin's performance, but actually the art in this is to make more than Bitcoin. If we take the time to trade actively, we have to outperform the benchmark. Now here are the monthly returns that I have made over buying and holding Bitcoin. So every data point is a month. This dotted line here is the 12-month moving average. And when we average out all of those dots, the monthly alpha over buying and holding Bitcoin for me is 2.1%. Now that might not sound like much, but that compounds over time. And then especially if we also add more money in the portfolio over time, we dollar cost average in, we have a quite nice smooth growth curve. So here's my active portfolio with trading and dollar cost averaging. And I hope that over the next 2 to 2.5 years, I'll be able again to double that portfolio. If we of course use leverage, we can make much more on a single trade. But I'm super cautious. I take very small bets. For example, have a look at this. I'm sharing my own trades. This is in the Gerhard Trade channel, and I opened again based on relative valuations a short of the Donald Trump meme coin. Trump relative to Solana was quite high, and it started to come down. And then our members also entered. They also had some leverage in there, so this was some gains. I waited a bit longer, closed this then at 141%. But because I only use 1 or 2% of my entire portfolio on a trade like this, the average alpha per month is only 2.1%. But if you're willing to take on more risk, you can of course grow much faster. Actually, our members do exactly that. So here's the channel, share your wins with some leverage and proper market timing and still reasonable risk management. There are several 100% in single trades easily possible. And so I think it's very important to forget about price targets, as in can Ethereum hit $4,000 or can Dogecoin hit $1, etc. Those kind of things don't really matter. What really matters is the relative performance. Capital within crypto moves from asset to asset. Attention moves from asset to asset. So there is all of the capital in the space. Sometimes it is risk on, sometimes it is risk off. But what really matters is where is the capital flowing to and where is it going away. And then all we need to do is to trade the relative valuation. It's much easier to make money that way. Again, would you rather hold this or would you rather hold this? And so yeah, feel free to check it out. It's currently $125 per month. You are locking in that rate. So when we come back to the 165 again in a few months, then you will still continue paying the 125. Whatever you're paying now, you will continue to pay. I will not increase the rate for everybody that's signing up now. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. There should be also somewhere a pop-up here on the right where you can click directly. It will lead you to the website. So see you over there. Cheers.